QuickBooks Pro Desktop 2021. Multiple currencies, adjusting entry related to accounts payable. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in our multiple currency practice file. We currently have the open windows open. You can open the open windows by going to the view dropdown, selecting the open windows list. In a prior presentation, we entered a bill, which is going to enter the accounts payable for the purchase of equipment that was purchased on account, meaning we didn't pay money for it, we didn't pay currency for it, but we'll be paying in the future. However, when we do pay it in the future, we're going to be paying it in foreign currency, so we had to put it into an accounts payable account that is tracking the foreign currency exchange rates for it. So let's take a look at that by going to the reports dropdown, and let's go down to the accounting and taxes and just take a look at this in terms of a trial balance this time. And then we're going to be changing the dates up top from 01/01/21 to 12/31/21. And we then have the accounts payable that was increased by the 41.6, and then the other side was going to the equipment that we put on the books at the 41.6. Now let's just jump over to our Excel sheet because we thought about this in terms of simply journal entries. What we're going to be doing is paying 400,000 yen in the future, foreign currency. We put it on the books by using the current spot rate at the point in time that we got the equipment, and then putting the equipment on the books and the payable on the books at the current spot rate or exchange rate at the current date of the time we're making the payment, even though we're not going to be paying the payable off until the future. Now, when we pay the payable off in the future, we're going to have a difference between the spot rate at the point in time that we purchased the equipment and the point in time that we pay the payable. In this case, this is going to be the difference down here. So that means that when we pay the payable, we're going to have to record that difference in the exchange rate, which will not be an adjustment to the machinery. We're not going to readjust the value of the machinery, even though when we actually made the payment in yen, it was a different exchange rate than the point in time we put the machinery on the books, but rather we're going to record a income or expense related to the difference in the exchange rates on the income statement. So in QuickBooks then, typically we would simply do that if I go back to the home page when we pay the bill. In other words, when we pay the bill and record the payment, whether that be by check or some of the transaction, when we do the second half of the transaction here, then we will typically be decreasing the accounts payable account, and it will basically record that change, that difference for us automatically at that point in time. However, we might have a situation where we need to record basically an adjusting entry in the middle here, say because we have a cutoff period that's going to be in the middle, and we need to make an adjustment to the accounts payable account. So we could have a situation there where we'd have to make the adjustment and then make the payment at another time, meaning we'll have 3 different exchange rate date points as opposed to just simply 2. If we think about this in Excel, then we have a situation where what's going to happen is we're going to have to make the adjustment for the current currency point in time with a journal entry, and then we can basically pay it off. So we're going to make an adjusting entry, one that you would kind of typically make at the end of the period in QuickBooks, but we're going to make it here in order to basically adjust our accounts payable to the point that it needs to be at, that we would then make the payment in the current exchange for the current exchange amount. So that means, so what we're going to do then, let's do it in Excel first and do this basically adjusting journal entry. So we're going to say now the accounts payable needs to be on the books for the current exchange amount. So we have the 1029 amount. The rate is 0.106. So if we pull out the trusty calculator, we got the 400,000 times 0.106. The new payable needs to be on the books at the 42. It's only on the books at the 41. So we're going to have to increase the payable to that 42, so we could subtract out what is currently there minus the 41,600. We'd have to increase it by $800. So the other way we can think about that is by taking the 0.106 minus the 0.104. There's the difference in terms of the exchange rate, the change times the 400,000, and we get that $800. Now, when we record the $800, we're going to have to increase the payable here. So when we increase the payable, that's kind of a bad thing, right? Because we're increasing the payable in the dollar equivalent units. So the other side is going to be a loss, meaning we had a loss going on here. Or you can think about it this way. This can be a little kind of confusing. If we had one yen compared to this many dollars. And now we have another yen compared to another yen. 1 yen can now purchase more fractions of a dollar than they could before. In other words, the yen got stronger in comparison to the dollar. The yen got stronger in comparison to the dollar, and we promised to pay 400 yen. 400 yen, which are now stronger compared to the dollar. The yen got stronger, and we have to pay in yen. That's bad for us. That's why we have basically a loss. In this particular situation, that would be bad for us. So then we're going to say, all right, we're going to have to increase the accounts payable. So the accounts payable is going to be the credit, which we'll put on the bottom, accounts payable in yen. And then the other side is going to be going to a gain or loss. We once again are not going to be changing the value of the machinery that we purchased. We're still going to keep that on the books as of the spot rate at the point in time that we made the initial transaction. So in this case, this is going to be a loss. So we'll record a loss over here. And then I'll recalculate this just simply in Excel, which would be then equal to, I'm going to put brackets around it, do it this way. This is going to be this amount minus the prior amount, close the brackets, times the 400,000, and there's going to be that $800 debit and credit. So if we record this out, then I'm going to record the loss. We'll have a loss here, which will be equal to the 800. So the 800 is the loss. The other side is going to be going to the payable. So the payable then is here. I'm going to double click on that item, double clicking on it, and I'm going to say plus, and then we're going to be saying we want that 800. Now the payable's now at that 42, which remember we said was going to be the new amount, because if I take out my trusty calculator, we've got the 400,000 times the 0.106, and that's going to be the 42.6. So there's the 42.6. Now we need that amount in Excel so that we can then value the amount that we're actually going to pay. So, but again, we want to think about it in QuickBooks as if it's an adjusting entry, like at the end of the time period, at the end of the period, we have to record basically an adjusting entry. So we'll think about it that way in QuickBooks. So if I go back to QuickBooks, how can I do that in QuickBooks? Well, we can then go to the lists drop down and take a look at we want to take a look at the price level list, or the currency lists, I should say, currency lists. And we want to then make an adjusting entry. So we're going to let it do it automatically for us. So I'm going to say we can hit the drop down. Now we could download the latest rates if it was the current day, the current time period, and that would populate the rates for the current time period. We're working in the future, so we're going to have to populate our own rate here. So we're going to populate the rate here, and that's going to be for the amount on 1029, it's going to be that 0.106. So I'm going to say, all right, on 1029 to 1.106 is going to be the new rate. Let's check that one more time. That's correct. So I'm going to say that looks good. So then let's go ahead and say okay. And now I want to tell QuickBooks to make an adjusting entry for me by going to the activities drop down here, and I want to say, would you make an adjusting entry? So I want you to make an adjusting entry, and then I'm going to say make it as of, we said 1029, so I'm going to say 1029 to 1, and we want to do it for the yen. So do it for the yen at the 1.106. That's correct. Let's do the calculation. So there we have it. It's proposing to do this adjusting entry. We have the 400,000 for this particular vendor in accounts payable. The 41.6, I believe, was the prior point. 42.4 current point. Change then $800. That will be the adjustment. Yes, that looks good. I'm going to check it off. Please do that adjustment for me. What will happen when we do this adjusting entry? It will adjust the accounts payable to the current amount, like we did in Excel. The other side then should go to an income statement account, not affecting, once again, the purchase that we made, which was the equipment. So I'm going to say, all right, let's save and close that. Let's check it out. And then go on back to our trial balance. Our trial balance, which you can open by going Reports, Accounting and Taxes, Trial Balance, 1/1/21 to 12/31/21. And so now we have the equipment still on the books. We didn't change the value of the equipment, but now the accounts payable did change to that 42,400. Double clicking on that, then we have the original amount of the bill using the original spot rate, and now the $800, adjusting it to what it should be as of this point in time. We're assuming here we did so in QuickBooks because we wanted to do it as of the cutoff date. Maybe we're making financial statements as of the end of the month. So we're going to then close that back out. And then the other side went to the exchange gain or loss, the 460. If I double click on that, notice it's netting these two out. So these two netted out. So we had the prior gain and now we have the loss netting out. Whereas on our worksheet over here, we broke them out between gains and losses in two separate accounts. So if I was to highlight those two, the difference or between them, the 460, that then ties out to what is on QuickBooks, which is basically using one account, which will go up and down or flip one way or the other way, depending on whether we have more gains or more losses. So I'm going to close that back out. And so there is that transaction. If I go back to the home page, then the next thing we're going to do is pay the bill. And again, because we're paying the bill and we enter this middle transaction, we're going to have kind of this problem that we're going to have to reverse the transaction. We did it for two different purposes once again. In Excel, we did it in order because that's part of the process we need to do for the journal entries to pay the bill. In QuickBooks, we're thinking about it as something you may need to do if you have the period end cutoff date that you have to make the financial statements for, and then you'd have to enter that and then do a reversing entry. So if I go back to Excel, in other words, when I make the transaction to pay the payable, I need these two to be in place, the 42.4, and I'm going to then do it with two separate journal entries instead of what would be done in QuickBooks, which means when we pay the bill, it would then it would hit the three accounts for me. It would do the difference between the exchange rates and record the gain or loss at that point in time. Therefore, if we did not need the cutoff point in the middle, we wouldn't have to do that adjusting entry, but simply go from the bill to the pay bill, and QuickBooks would then record the transaction for us automatically. Also note that we don't have any money at this point in time in yen. We have US dollars and we have Canadian dollars. Therefore, we're going to have to make a purchase of yen. We're going to have to transfer some of our money to yen in order to then pay off the money in yen. So we're going to have to take some money out of our checking account here in dollars, transfer them to yen, have a bank account in yen dollars, and then we can use that to pay off the yen, which is going to be 400 yen, which is equivalent as of right now to 42,400 US dollars that we have it on the books for. So that's where we stand at this point.